Charlie, your reach is immense, and tonight you can reach the class.
Thank you, Joe. Well, I think it's more a tribute to the reach of MIT than the reach of me. It's up there on the open courseware, and it's, this presentation will be available. Joe's actually uploading it now. And the template that we're going to walk through at the end of the presentation is going to be up there as well, and that's going to be your starting point. So we're going to take some of the information that Rich talked about. You know, if I had done Rich's presentation, I would have taken Apple and Dell, and then we would have looked at the financials, and we would have said, we would have talked about the same story he went over, but we would have then looked at what does it mean for the financials of the business. And so we'll go through a number of different industries and look at their financials and help you think about what are the dynamics of the industry that you're going to compete in and how should your financials look. So we'll start at kind of the 30,000 foot level and then we'll really dig in at the kind of the treetop level with a spreadsheet and walk you through putting together that spreadsheet. And if we have enough time, which I think we will, we'll talk a little bit about sharing the pie, meaning you're going to start a company, you own 100%. As that company grows, you're going to own less. Board members are going to own some. How to think about distributing that equity and having a gain, just like your financial plan, have an equity plan as well. So plan it from the beginning and then execute against that plan. As Joe mentioned, I was at third place in the 10K contest, and we got $300 to split between the three of us, and it took about 3 months to get it to us. There were not any venture capitalists lined up to talk to us. And then I spent the summer as a venture capitalist, as an associate at a venture capital firm, really kind of looking at the industry from their eyes. And so it was a great experience for sitting on the other side of the table from them. Joe introduced me to some fellows at NetScout Systems who had an idea for a product that would help large enterprise-wide large enterprise networks, help them monitor and manage the traffic that was on their network. And over time, we grew that to $80 million in revenue, took it public in 1999, and the company is actually still around and still doing very well. The challenge that we had at NetScout was, as Rich was talking about, identify the customer's pain. And so the challenge that we had at NetScout is we helped networks run more efficiently. But the pain was a very subtle pain. So for example, slow response time. Well, how much does, so you had some operators sitting there saying, well, the computer's slow today. You had customer frustration, but it really wasn't, companies didn't recognize that as a cost. The other thing that we said was, well, if you managed your network better, perhaps you can buy less network. You can use your pipe more efficiently. And again, companies really didn't get that. But what we found was we found an industry where speed was critically important. And so we made our first inroads into the financial services sector. Goldman Sachs was, in fact, our biggest customer, was $1 million a year customer at a time when we were doing $2 or $3 million a year, and they continued to order $1 million worth of product as we grew significantly. And why? Because they recognized that executing a trade 15 seconds faster or 5 seconds faster than the next guy would more than pay for the $1 million that we were that they were spending on our equipment, as well as all the other benefits in terms of right-sizing their network. I then joined Reveal Imaging, which made bomb detection equipment for aviation security. We made a CT scanner that was that you would feed a suitcase in, and it would give you a green light or a red light based on explosives being in the bag. So it was a very different kind of industry. Our customer was the TSA, and a very different model from the NetScout model where we bootstrapped it from day one. We didn't take a dime of venture money. We would have loved to have gotten some, but we couldn't, but it was a very tough climate to raise venture money. We didn't take a dime of venture money until we were doing $6 million in revenue. Whereas Reveal, before we had our first dime of revenue, we'd already raised about 11 or $12 million. So a very different experience there. Over this time, I've raised about $125 million in probably a dozen transactions. While I have the soapbox, Joe talked about my buddies who were in the laser projector business plan contest with me. And as we got close to graduation, I said, guys, I really want to do something entrepreneurial. But they, like a lot of my, and we had a very active entrepreneurship club at Sloan. But they, like a lot of my team members, I think that what I call is they pulled the resume ripcord. They were concerned about, how would joining a startup and having that fail. I think there's a lot less fear of that failure today. But I think people were very concerned about how that would look. And many classmates went into the tried and true consulting. They went to Wall Street. Or they went back to to larger established technology companies. And what I found is the reason to get involved with entrepreneurship now is, first off, the workload. We're all at MIT and we're used to a workload that's like here. So you'll join your company and you'll work harder than anyone else, and you'll still say, God, this is a lot less work than I was doing at MIT. And the second thing is we're used to eating pizza about 4 times a week. So your expense level is extremely low as a student. And so you'll go, wow, I'm making more money than I ever made before, but it's still a startup salary. And the problem is that once you get out there and you go take the high-paid job, or even even kind of a mid-level job at a big company, the lifestyle escalates right in line with that salary, and it becomes harder to take a step and form, and take that leap into a startup company because you have the expenses coming in. So I would say now's a great time to do it. At Reveal Imaging, the day we kicked off, the Reveal Imaging was 10 guys in a barred conference room with a whiteboard sketching the ideas for our product. That's how far we were along. Now, the other 9 guys in that room all had between 5 and 15 years of Homeland Security industry experience. I had none, but I had a lot of experience raising money. So from that meeting, we looked around the table. A couple guys had jobs that they were going to have to quit to join. Everyone nodded their head. We're in this thing. I got out of that meeting. We started making, I got out of that meeting. I wrote a check, and the CEO wrote a check, and we started the angel round, the 2 of us. And within 3 months, we raised $1 million in angel money, really friends and family money, because it was people who knew us. They knew we put our money in, and they heard the story and came aboard. But we started the venture funding, looking for venture funding at exactly the same time. Took 6 months to complete a round, and then we did some type of financing every 6 months from there on out. And what the finance plan did was it helped me figure out how much money we needed to raise in the next round, and it helped me figure out what form of financing we needed or we could get. And it provided the story to those investors to convince them to make that investment. So, like Rich, anytime there's any questions, feel free to raise your hand and shout them out. So let's think about the audience for your business plan financials. Okay, I'm going to assume that your audience is either a venture capital firm or a 100K judge, a lot of whom are venture capitalists, right? So when you talk to a venture capitalist, what are they looking at? So let's think about the audience for your business plan financials, and just like I did, spend a little time in their shoes and look at how they're going to look at your presentation. So here's what most venture capitalists will tell you that they're looking for. they want to get 3 to 5 times on their money. So if they put in $1 million, they want to get $3 million to $5 million out. If they put in $5 million, and at that point, they're happy to put more money in if they can. If they think they can get 3 to 5 times, kind of the sky's the limit in terms of what they'll put in. They have a 5 to 7 year investment horizon. And so let's say that while that sounds like an egregious amount, a 4 times return in 5 years works out to a compounded return of 32% a year. I mean, it's really good, but it's not, it's not exorbitant. It's not loan shark type rates, right? The other thing that VCs want is they want to have a significant amount of money invested. So they don't care if they can get a 5 times return, but they can only put $100,000 in, because these guys are managing funds that have several $100 million in them, if not more. 400, 500 million is not uncommon. So getting a 20 times return on $100,000 doesn't really move the needle. You've got to get a lot of money to work. And they also, because they can only spend so much time, because they only have so much time, and all of their investments they get board seats on, they want to have a significant ownership percentage of your company. So I was on a panel once many years ago, and someone said, well, how much of my company am I going to have to give up to raise money? And I was the CFO on the panel. There was also a venture capitalist and I think a banker on the panel. And the venture capitalist said, well, there really isn't any formula. But in reality, there is a formula. And here's what the formula is. It's the percentage of money that they're going to get is equal to the money that they invest divided by the pre-money valuation plus the money that they invested. And we'll go through some examples on this. So the pre-money valuation is what your company would be worth prior to investment. So it's just because we know the formula, it doesn't mean it's going to be easy to plug in and spit out an answer, but at least you're now working on using the same vocabulary that they're going to use when they're in the middle of negotiation. And so the post-money valuation is just pre-money plus whatever they put in. So let's look at an example here. So if a venture firm put in $5 million on a $5 million pre-money, that would be 5 over 10 would be 50%, right? Then if they did a second round, a B round, and they invested $10 million on a $15 million pre-money, the amount of money that the B shareholders would get would be 10 divided by 25, 40%. But what happens to the A shareholders is that, like everyone else in the company, they're going to get diluted by 40%. So diluting 50% ownership by 40% gets them down to 30%. Combined, let's assume that the Series A and the Series B investors are the same firm. Combined, they now own 70% of the company and have invested $15 million. And so to get their 3 to 5 times return, they need to get out $45 million to $75 million. And if they own 70% of the company, it's kind of simple math. You've got to get your company valuation to $65 million to between $65 million or $107 million. And so as you think about kind of the last line on here is the important line, right? This is all kind of a given. In order to get to a valuation of 65 to 100 million, you've got to grow your company to about $50 million. Now, I ran into one of the investors in Reveal Imaging. We grew Reveal to 100 million and sold it for 230 million. And now it started, now look, this past decade hasn't, other than the social media space, it hasn't been a great time for venture investing. But I will say to you, the guy may have been blowing smoke, but he said, hey, Charlie, it's great to see you. You know, you should check in with Chip, our other, the venture partner who was on your board. We'd love to have you come down. In fact, I mean, your name came up last week. We should name a conference room after you guys. You are our best investment in the last 10 years. And we grew that to 100 million. So as you think about your business plan, I know you all have the best ideas in the world. And I know that many of you think that these could be 500 million or $1 billion businesses. What I'm trying to convince you is that your investors will be thrilled if you can grow this business to $50 million in revenue. And then at that point, we can decide, do we sell the thing for a couple $100 million, or do we double down and put another 10, 20, $30 million into this thing and grow it to 500 million? But either way, they're going to be happy with that investment.
That's a question.
Yes.
Calculating the valuation of the company, does profit have any influence on it? Just the revenue, right? Profit level?
Yeah, so the question is, in calculating the exit price of the company, should it be a revenue-based multiple or a profit-based multiple? I always think in terms of revenue, because while I like my companies to be profitable, and I almost insist upon profitability, right? We build profitability into my business plan financials, and then we march along those financials. The reality is we're not driving the business for maximum profitability. We're driving the business for growth. We're balancing those two. And so to value the business off of a 10 or 15% operating profit really sells us short, because we could have a 20 or 25% operating profit if we weren't trying to grow 50% a year. So I think that for a growing business, revenue multiple is a much better multiple. It's better for the entrepreneur, because then you're not operating at cross purposes. So let's talk about the income statement, right? So it starts with sales or revenue. And in this case, $50 million. And that would be after any discounts. So if you're selling to, if you give customers a volume discount, of 20%, you don't get to say we sold 100 million, less discounts of 20 equals 80 million. Your revenue is 80 million if someone gets a 20% discount. If you're selling to the channel and you give your channel partner 20%, it's whatever is on your invoice going out the door, and whatever size that check that comes in that's your revenue number. Your cost of goods sold is going to be the cost of any material that goes into your product. It's going to be the cost to assemble it. It's going to be the manufacturing space where that was assembled. But it's also going to be technical support. So if you're providing post-sale support, whether it's under a 90 or a 360-day warranty, or if you're selling support and then providing extended warranty or some kind of software updates, that would be in your cost of goods sold. The difference is simple math, and that's your gross profit. And what I will try to impress upon you is kind of all good things start at a high gross margin. So below that line is sales and marketing, so that'd be your sales force, going to trade shows, advertising, that type of thing. This is R&D is going to be where your product development staff is, whether it be in-house or whether it be offshore. And general administrative would be your CEO, your CFO, and your accounting department, HR department, those types of functions. Add those up for your total expenses and subtract them, and that gets you to your operating profit, or EBITDA. Okay? So I get sent a lot of business plans, and feel free, my email's on here. If you guys have a plan and you want me to take a quick look at it, or executive summary or something, feel free to shoot it to me, and I'll within a couple of days, I'll generally get back to you with a couple of comments, and just It's always good to get an independent person's opinion before you send it to your real potential investors, right? So if I get sent a business plan, here's the first thing I look at when I look at the financials is the top line. I said, how big do these people think this company is going to get, and what's the ramp look like? Is it a million, 100 million, or is it a nice steady path, or so what does this look like? How do they see this business evolving? The second thing that I look at is out in year 4, what is the profitability? Where is this company spending its money? And this is what I think of as the business model, is in percentage terms, what's the gross margin of this business? And then other than gross margin, where are they spending their money? What are they spending it on? And then the last thing that I look at is I look at the operating profit line for those 4 years, because this gives me a good ballpark figure for how much money this company is going to need in order to get to profitability. So if I added up if I added up the 3.3 and the 2.5, it's roughly 6 million. Maybe there was a little unprofitability here, but it's somewhere in the $6, $7, $8 million range. It's not $15 million. It gives me a sense of what this business is going to need to get it going. So as you look at your income statement, here's how I think you ought to think about it. So same thing. We're going to start with the top line. How big is this opportunity? How are we going to go after that opportunity? How much market share? How big is the market, and how much are we going to capture? Also, think about your business model in year 4. But then, what I would start with is your expenses in year 1, and we're going to go through that and figure out how to. This should be simple, to figure out how you're going to spend your money in year 1. This is an indication to your investors what you think is important and what are the things that we really need to be working on. Ignore the percentages in year 1, because who cares? You're going to be losing money. It's all about what are our priorities. Let's look at our spending in year 2. Okay, so now maybe we've got a product ready to release. Maybe we're going to start to do some sales and marketing in that time. We're going to start to see some real revenue. What are we going to spend money on? And that's when I would look at the business model in year 2 in terms of percentages and figure out how to make year 3 be a smooth transition to year 4 or year 5. Because in reality, look, years 3 and years 4 in your business plan are kind of like this. But what you're saying to yourself, what you're proving to yourself and to your investors are, we understand how this business is going to operate and what are the critical things to be doing. So we're going to walk through how to get there. So to me, the business model, kind of thinking about that year 4 financials, that's the superstructure. That's where we want to get to. And all the thought in terms of your financials are going to be, how do we make our business look like that? It's going to talk about how your business is making money, and as I talked about, it's the financial performance in percentage terms. When I think about business plans, the business model though, it's when your business reaches critical mass. Now I have an example here with 4 years. Maybe your business is 5 years. Maybe your business is 3 years. Maybe. If it was as Rich was talking about, a pharma business, their business model reaches it in 13 or 14 years. There's a long latency in putting together a business plan like that. So think about critical mass could be we reach some milestones, and so if we're building a product, we reach some milestones where we get economies of scale, either in our production, We reach some economies of scale in terms of our marketing. So let's say we're going to have 20 stores in Massachusetts. We get tremendous economies of scale with our advertising there. If we're building our 10 millionth computer, we're obviously going to have economies of scale from building that computer. So you need to think about what are your economies of scale? What is important to your business? So let's look at some business models here. Names that you're familiar with in the retail sector. They're characterized by pretty lousy gross margins. Slightly better at Nordstrom's. I was kind of surprised that Nordstrom's, which is focused on I would say, it's a B plus of retail, focused on high service. Their gross margins aren't that much better than Target, but as you would expect, their sales expenses, which is in the SG&A category, are higher than Target because their sales staff probably gets paid a little bit more. They probably have a little, their stores are a little bit nicer, so their stores cost a little bit more. So when you look at the business model in percentage terms for these companies, you can actually see how their strategies play out. One other figure that I look at pretty closely is revenue per employee. And again, it's interesting how across sectors, across companies within a sector, the revenue per employee is pretty consistent. Now, in retail, I understand that it's revenue per square foot is a big metric, and so there's certain metrics that are within various industries that are closely followed, and you can go through here and figure out, how their strategies impact their revenue per square foot. If we look at restaurants, I know that same store sales, so they base this on location, so it's revenue per location, not per square foot. Again, fairly low gross margins for McDonald's and Wendy's, but very high gross margins for Starbucks. I saw something the other day that said Starbucks actually pays more for health care benefits than they do for coffee. What a great business that is, right? So 58% gross margins, but all those comfy sofas, the free internet, cost money, and your staff is going to cost more as well. So your SG&A is 42% for Starbucks, and in reality, their operating profit is actually worse than McDonald's. So if you look at McDonald's does about $2 million per location. Wendy's does about $1.5 million per location, and a Starbucks does about $1 million per location. So that's one, they just can't drive that same amount of business through a given location. But again, the revenue per employee, very different from the retail sector in the $40,000, $50,000, $60,000 range. Yes?
Why do we care about the revenue per employee? Why don't we just look at the operating profit?
Okay, so the question is, why do I look at revenue per employee? So greatly, instead of just plain operating profit. And in reality, we don't care, but it's going to be so let's think about this. Let's say that my revenue per employee is $45,000, right? I can't pay that employee more than $45,000, or else there's nothing left to spend on hamburger meat or restaurants. So it means that my employees are going to be making $15,000 or $20,000 a year. So I've got to build that into my plan, that I'm going to have to be able to get by with people who are willing to make $15,000 or $20,000 a year. Now, we're all starting tech companies, right? Okay? And I can tell you from experience that your average salary in a tech company, unless you have like a huge manufacturing group or maybe a huge call center group, but for the companies that I think many of us are going to be starting, your average salary company-wide is going to be $85,000, $90,000 a year. All right, if you're paying your employees $90,000 a year, and then you've got expenses on top of that, and then you've got to pay for your cost of goods sold, your revenue per employee is going to have to be a big number, $250,000, $300,000 a year. So the reason I focus on it is that as we get into the financial plan, a key driver is going to be staffing, because for our kinds of companies, it's going to be such a huge driver of our cost. And so we're going to have to modulate staffing to keep costs in line, both so that we have profitability, but also so that profitability doesn't go through the roof. Yes.
I have a technical question. Just on technicality about the last term, revenue per employee. Is that just a low-level employees, or do you take like everyone until, say, senior management?
Right. So the question is, how do I calculate revenue per employee? I just take the total revenue of the company divided by all the employees in there, okay? And we're just looking to get an average. Now, in a company like McDonald's, there's going to be huge difference between someone working the takeout window and the CEO. But we're looking for the average. You're going to see much more compression in the types of companies that we're going to be running. So let's look at some tech hardware companies. Now things are starting to get interesting, right? We've got margins in the at least 50% range, 60% range. Medtronic is in the health. It makes health products, but it really looks like a technology company. So even though they're in a niche industry, it's really a technology product, right? I think it's some type of heart monitor equipment, something like that. In fact, even better gross margins than Cisco or EMC. But what we now start to see is, unlike any of these other companies that we've looked at, we're now starting to see R&D spending is a significant amount. Typically in the 10 to 15% range. And then SG&A expenses kind of are all over the map depending on who their customer base is, how they're selling their product. But we have pretty good operating profits for Cisco. EMC, I would argue, is in a little bit more of a competitive business, a little less proprietary, more of a commodity business, so a little bit less profit margin. And Dell is really just in a supply chain business. I mean, Dell has virtually no R&D. Look how low their gross margins are. Dell is the McDonald's of high tech. Let's crank those burgers out as fast as we can. Do you want an extra gigabyte with that? So, and so it's a tough, as Rich said, he doesn't have the answer and I don't have it either. So, they're in a tough spot. Let's look at the revenue per employee for some of these companies, because now we're really getting interesting. Over 500,000 for Cisco. Dell obviously has to be a big number because, again, they're based on volume. But even Medtronic and EMC are in the $300,000 range. Yep.
Simple question.
Sorry?
How recent are the figures?
So the question is, how recent are the figures? They may be a year old, 18 months old. So I haven't updated this. I'll show you. I have updated for some of the companies, and they don't change that much. It's surprising. So now let's get into the software business. You'd think Microsoft, especially now, everything's being downloaded, you'd think that their gross margins would be 99%. But in reality, their gross margins are 81%. They still have support. They still actually send some stuff out in boxes. They still have to print manuals. And so, their gross margins are 80. They are what they are. Oracle and SAP, kind of in that 60, 70 to 80% range. Notice our R&D spending, very comparable to our tech hardware companies. Again, the SG&A really depends a lot on how they sell their product and how they market it. but very good operating profits here. Microsoft's is not as good as this anymore, so this is a little outdated for them. I should update it for that. The reason I put this in here is that I do get a lot of people sending me their business plan, and I see a couple things. One is I see revenue going to very high numbers, you know, $500 million, and profitability at 50%. And the reason I put this in there is that here we have a company, Microsoft, that at least for a good period of time had a virtual monopoly, and even they could, you know, I want to say only eke out a 44% operating profit. I mean, that's great, but to think that your business is going to have a better operating profit than Microsoft is just, it's not going to be credible, right? Again, revenue per employee depends on the business, but pretty healthy numbers there. And let's look at a couple internet real quick. Now, Google is definitely about 18 months out of date because I think their revenue is now up to $22 billion. But their revenue per employee is not that much different. It's pretty comparable. I think it's increased to about 1.1 million because I got called on this the last time I gave this presentation in September. And I went and looked it up. Their revenue per employee is about, you know, it's gone up a little bit. Well, it's gone up, you know, it's gone up $100,000 per employee. That's pretty good. But for them, it's only a 10% increase. So again, gross margins depend on your business. Amazon has high product costs, right? There's physically selling something and have to ship it to you. They still have significant, not immaterial R&D costs. And their operating profit, when I started giving this presentation 10 years ago, I actually questioned whether Amazon would ever be profitable because they had so many years where they were at minus a couple of percent. But, you know, they did turn the corner, and guess what? 4% of 10 billion, you know, it's a pretty good number, right? But it took them, they had to reach tremendous economies of scale to get there. We look at eBay. They're not delivering anything other than a service, so they have great gross margins, still a pretty high R&D number, and respectable profit numbers. So this next chart, I took a look at two companies I'm intimately familiar with. Now, look, these are tech hardware companies, but I would bet if I took Microsoft, it wouldn't be that dramatically different than this. And the reality is that the gross margins, this is over a 10-year period. So I'm taking 1990, my screen here is more blurry than it is up there. So 98 to 09, you know, an 11-year period. And looking at what happens to gross margins, yeah, they evolve. And that tells a little bit of story about what's going on with the business. But they don't change dramatically. And in the case of NetScout, what happened is they have their, in 1999, the company, the total installed base was probably less than $1 billion, okay? But they were running at about $100 million a year and growing, and since then, the installed base is probably $3 billion, you know, another $2 billion, right? So, you know, almost all of their customers are on a maintenance program at 18%. While there's some technical support that goes along with that and some warranty expenses if the hardware fails, it's a pretty good business to be in. In fact, it's better than the product business. And so as that installed base grew, their gross margins grew. So I bet if you were able to segment, and they don't do it in their financial reports, if you were to segment product sales, maintenance, and we're able to calculate the gross margins on both, I bet those gross margins for each product line was pretty similar across the period. But what happened is the maintenance revenue became an increasing percentage of the total revenue. That's my take on what happened to their gross margins. And then while expenses do vary over time, you can see NetScout is spending between 12 and 14% on R&D over this period, and Cisco is pretty much the same, right? So yeah, as sales go up and down, and you know the vagaries of the market, you can't always project the sales. You can't always deliver sales that go like that. What happens is as sales take a dip, sometimes you decide, we're going to keep all the people in the sales and marketing department, and that as a percentage is going to show up 1 year higher than the next year, but then return to what our more normal model is going to look like. Also, annual revenue per employee doesn't change all that much. I think part of this is guys like me, CFOs like me, we look at what our numbers, we look at the numbers that have worked for us, and we say, we've been successful spending 12% on R&D, and we build that into the budget, and that becomes our model going forward. So it's hard to say what's the chicken and what's the egg here. Do you build the plan and the model's working, so you do it again, or is it the model that breeds the success, right? Hard to say. So putting together your model, right? You think about your product. Is it a product? Is it a service? Is it a combination of the two? And what is the price that customer is going to pay? Is it, how much, what is the pain that you're solving for them? Are you helping them save money? Are you helping them get to market faster? Is it, what are the competitive products out there? So I'm sure that a lot of people have talked about thinking about your customer and your product and can do more justification to that than I can. But, as you think about your product, what I would say is, NetScout sold a headless PC that would sit on a network. We also, and that was in the early days, that was a $2,000 product. We also sold management software that would run on a Unix workstation, and that was $25,000. And so as we thought about our customer, the average customer initial order, they'd buy about 10 of our probes because they would have a distributed network, and they'd put one of our probes on each of their distributed networks, and they'd buy one copy of the management software. And so our typical average, so our average selling price, if you will, would be $20,000 plus, what did I say, it was $15,000 for the management software. So it'd be $35,000 would be kind of a typical sale. Now, when we get follow-on sales from those customers, typically 10 to 20 additional networks a year as they built out, either they built out their network or implemented our product on more of their networks. But if we thought about the average sale being $35,000 a year, we then could think about, well, how many sales do we need in order to get to $1 million in revenue or $5 million in revenue? And then if we have an installed base that's going to continue to buy products, how much is our installed base going to contribute? So the installed base, if we're saying they outfit another 20 networks, that's an additional $40,000 from each of our installed base customers. So you can actually think of it as, rather than think about selling units, maybe we think about this as selling to customers and what's a customer worth, and as that customer evolves, how much are they going to contribute to our revenue? The second part is pretty easy. You should be able to figure out what your costs are going to be. You have to build it. It's either software and you have to pay support, or have a server, or outsource some kind of cloud operation, or it's a hardware product and you have to build it, or you outsource it and you know what the price is going to be. So that part of the equation is usually pretty easy. We're going to talk a little bit about distribution strategy, and what I would say is that if you're building a tech company, your R&D is going to end up in the 10 to 20% range. It'll be higher, certainly a lot higher than that in the beginning, but over time it's going to come down. And G&A is also going to be significantly higher in the beginning, but it should come down to the 5 to 15% range. And build in, don't drive this thing, don't drive your company for maximizing operating profit, drive it for maximizing growth, but build in an operating profit, because investors like to see that, and CFOs like to see it. And I'll tell you what, once you turn from unprofitability to profitability, You know, your destiny is in your own hands. You no longer have to take money on the terms that are being offered. You can decide to delay taking money, and so it's a very happy day. So let's talk about distribution real quick. So I've got two examples up here. So one is you're going to sell it through a direct sales force, and I'm just showing this to show how this would impact your numbers. So here you're selling product $100 million worth. Your cost of goods are $40 million, giving you a 60% gross margin. You have sales and marketing expense, R&D, G&A, and it gives you an operating profit of $20 million or 20%. But if you go through a distributor, you say to your distributor, hey, listen, I can't handle the sales. You handle the sales for me. I'll give you 20% off the top, so I'll sell it to you. I'll sell you product for $8,000. You go to the market and sell it for $10,000. That'll be our list price. And you get to keep the $2,000, but you have to do all the sales efforts. Your cost of goods sold is still exactly the same. You still got to build the exact same amount of product. As Rich mentioned, your channel does need care and feeding. They're going to need product literature. They're going to need training. They're going to need someone to go with them on sales calls. They're going to need someone to ride herd on them to make sure that they're actually selling product. Answering technical questions. So your sales force isn't going to go down to zero, but it's going to be dramatically diminished. Your R&D, though, is still going to have to be enough people to build the next generation product, because that's what we really have, is we have, that's what we're offering is new and improved products. G&A is going to be a little bit less because you have fewer people, and salespeople are notoriously challenging to manage. So you get down here and you still have a 20% margin, but it's only $16 million in operating profit, but your business model looks very different. And I'm not saying one is right or one is wrong. It's just recognize up front the difference that this is going to make. Now, maybe this $80 million can quickly grow to $106 million if you use distribution. Maybe not. Maybe if you do with distribution, the guy walks in with his bag of stuff and your product withers on the vine, and this $80 million becomes $40 million. So I think the distribution is more of a strategic decision, certainly not a finance decision, but it has a huge financial impact. So as you put together your finances, I've got this template that I'm going to share with you. I know there's a lot of sophisticated business planning software out there, and it's kind of like TurboTax. They ask you questions, you plug in this, you plug in that, and it spits out a nice, neat business plan financials. What that doesn't do is, what you really lose is the real value of putting together your business plan. And that's understanding what the levers are. What is the lever? Taking a $2,000 product and getting $2,200 for it? Is it taking an average customer sale of 10 units and $15,000 in software and turning it into 20 units and maybe charging $15,000 for the software? Or is it getting our cost down? So it helps you understand what drives your business and what are the changes, what are the important decisions that you're making? And we'll go through one company here and look at some of the decisions that they made. When I talk about rules of thumb, these are going to apply to technology companies, and they're going to be apply to making your business looking interesting to investors. Now, you might have a great business idea. 3 of you are going to go into some kind of consulting business, or maybe it's a niche product, and you're going to grow this thing to $5 million, and you're going to have a 40% operating profit, okay? That could be a great business for 2 or 3 people, but if it's going to stay at $5 million and never get bigger than that, no investor outside of your family is going to want to invest in that, because they're all looking at this, because there's no exit strategy for a company that's not growing, okay, that doesn't fit kind of their investing model. I've already talked about what I typically see as the most common errors in business plans. So we talked about staffing earlier. Staffing is what drives your expenses, okay? And so in the template, You're going to have a one page dedicated to staffing. And I would urge you, when you put together your financials to present, put a staffing plan in there. Because staffing represents your biggest expense, and it shows where you're putting your resources. What are you spending that scarce cash on? Where are the resources? So as you put together your staffing plan, you'll have it broken out by department, and we'll talk a little bit more about that in just a second. But when you look at your benefits, a lot of people here, well, General Motors pays their line employees $25 an hour, but their loaded cost is $50 an hour. So I see a lot of people load too much overhead into the salary. You're not following the GM model, which has pensions, which has vacations, which has holidays in there. And so a guy who works, so don't use the GM model. People get a salary, they get $85,000 a year, and then on top of that, you have to pay 7% FICA, and you have to buy them health insurance. And so that works out to be about 15% on top of that. And so add 15% on to whatever you think you're going to pay an employee, and over the group of your employee base, that'll come out to be a pretty good number. I was just working as a consultant at a company that we sold to Deloitte, and I came in, this company had been around for about 8 years. They had 40 employees, and I came on board, and I'd been there for about 2 weeks. I was getting ready to do one of these presentations. I said to the controller, I said, Janice, do me real quick, bring me the payroll for last year. And then we took that and we divided by the number of employees. It came out to $90,000 per employee. And I said, okay, so let's say their expenses were $4 million, their salary expenses were $4 million a year, and their total expenses were $6 million a year. So their total expenses were, 150% of, so their salaries represented 66% of their total expenses, which is completely in line with what I've seen in every company where I've put together the financials. So here was one where I kind of came in late to the game. The company had already grown to 40 employees, but yet they were following kind of these same metrics. So salaries are going to be about 2/3 of your expenses, and your sales staff is going to cost you about $200,000 a year. So we talked about what you should grow your financials to, revenue per employee, and what I would say is revenue per salesperson. If we think about NetScout, right, and my average sale is going to be $35,000 per sale, right, per customer, and I want my sales guy to do $1 million in business, $1 million to $1.5 million, well, they've got to do 30 to 50 sales a year. So does that seem like a reasonable number? When investors are going to ask you, what's your sales model? What's your average selling price? How are you selling this? And they're going to be doing this math in their head and say, do I really think someone can go out and sell one customer a week on a $35,000 product? Yeah, seems reasonable, okay? So it passes the sniff test. Now, could you say someone's going to sell $2 million? Could you say you're going to get by if they sell $1 million? Sure, but it passes the smell test. So Open Table is a company, so I get, where can you get data on companies that are like yours? Open Table is a company that does these online reservations, right? So you go online and say, I want to go to XYZ restaurant, and it tells you what times are available, and you book it, right? So they just went public. So I went online and looked at their information to kind of help you think about how I think about their business and how investors would think about their business. So the first page here is just information that was available from their S1, from their IPO filing. They had 12,300 restaurants signed up in 2009, and they grew that to 15,200, an increase of 2,900 restaurants. They seated 43 million diners, and they grew that to 65 million. And then here were their three revenue streams. Subscription, 44 million, reservations, 48 million, and installation, 7 million for 99 million total. And then here were their expenses, with the number of staff in each department, right? And so they had an operating profit of 26 million or 26%. So those are just the facts, right? But we can do some analysis on this. We say, they had subscription revenue of 44 million, and they had an average of between whatever the 13 million and the 15 million. It came out to 13,750 restaurants. So they're getting subscription revenue of $260 per restaurant per month, okay? It's just simple math. Reservations, they booked 65 million diners for 48 million, came out to 60 cents a diner, okay? Now maybe they charge more for the first diner and less for each add-on diner, I don't know, but it came out, but the averages will tell us something. And then installation, they installed 2,900 restaurants for $7 million, so they got $2,400 per restaurant. And if we look at their revenue was $200,000 per employee, okay, not bad, I'd like to see a little bit more. Their expenses were $148,000 per employee, and if we assume that 66% of their total expenses are salaries, then their average employee made about $100,000 a year, which follows Charlie's rules of thumb, okay? They don't do print or broadcast ads, so they just use their sales force to sign up restaurants. And they had 160 sales staff. So that came out to be $125,000 annual expense per sales staff, which seems pretty low to me. But if we figure that there's sales staff and then there's support staff, and that the 160 actually represents 80 people selling and maybe 80 people supporting them, that's really $250,000 what that really means is that there's 36 restaurants per rep per year, but that's a very anemic $311,000 in revenue per sales employee. So I'm a little concerned about that. I do have some other red flags as they looked at their target market, and they said that they've really got very good penetration here. So that's a downside. But their opportunity is, they've only got 10% of the people who actually go out to a restaurant use their service. So a couple of things worried me about this. If we look at acquisition cost, they paid $20 million to acquire 2,900 customers. So that came out to $6,900 per customer, right? $6,900 to acquire a customer. And if we look at the total revenue from that customer in year one, they get an installation fee of $2,400, a subscription fee, a per diner fee. They only get $8,000 in revenue for that customer. So they get a new customer, and they only make $1,000 on that customer in that first year. So you better know this when you're putting together your financial models, because this is a business that as it ramps up, it is going to just consume cash, because your new customer, the more customers that you get, the less cash you're going to have, because I didn't add into here, they're probably going to have to put some hardware out at the customer side. I don't know. I don't really know their system, so I don't know what they put in the restaurant, whether there's some interface or whether they just install software. Yeah, question here.
When you say customers, you mean the actual restaurants?
Yeah. So the question is, who's the customer? So to me, they're selling to the restaurant. So the restaurant is buying a service, and that service is bringing in patrons. Okay. So when they acquire a restaurant, they get $6,900. Costs them $6,900, and they only get $8,000 worth of revenue. But here's the rub. Let's look at if you add in years 2 through 5, the customer represents a revenue stream of $70,000. And you don't have to pay that salesperson again, and you don't have to install the hardware again, and the subscription fee is, that's 100% gross margin business. And there's the per diner fee, there's a little bit of a rebate that they pay to customers. In fact, I did this. I said, hey, I haven't collected my rebate, so I've got a $20 check at home for any open table restaurant. But it's a pretty good. Once this thing takes off, it's a pretty good model. So as we look at what were the key business decisions that got made, who pays? So as you're putting together this service, you say, well, maybe the restaurant patrons would pay, right? Maybe I would pay $1 to go book. When I go to the movies, I pay $1 to book online, right? Why not pay $1 to book a table online? I mean, I don't know. Maybe that would have worked. I don't know. So maybe they could have done this through advertising. They decided to focus on the restaurant and let the restaurant really be the person who carries the freight on this. And so if you decide it's going to be the restaurant, what are they paying for? They're going to pay for installation, they're going to pay a monthly fee, and then they're going to pay a volume-based fee. And then how much is that going to work out to be? $2,400, an average of $260 a month for the monthly fee, and an average of 60 cents. You know, in hindsight, it seems like it all makes a lot of sense. But when the 10 people were sitting in the conference room with a whiteboard trying to figure this out, I'm sure that these were all very tough decisions. How about $99 a month for the restaurant? I don't know. Maybe they'll pay $500 a month. You got to get out there and see what they'll pay. I think also early adopters to their model, you probably had to make it much more compelling for them, because now they're in a position that they have so many restaurants that now for a new restaurant they can almost write their own ticket, because I can book on so many restaurants. Now if a restaurant isn't on OpenTable, they're losing out on an opportunity. That was certainly not the case 5 years ago. It was a rarity that the restaurant was on OpenTable. So I think as time goes on, their business model can evolve. So just like they had to make a lot of decisions, you're going to have to come up with these decisions and then be able to explain those decisions to investors, and they're going to be reflected in your financial plan. So I also did a study here of LinkedIn. I know a lot of people think about this, either the advertiser model, and so let's create a website that gets a lot of traffic and we're going to charge vendors. All I can say is, here's LinkedIn, pretty big company, right? $80 million in advertising revenue. So, you're going to start out here. LinkedIn is here. You have the bottom line here is you have to get really big in order for this advertising model to work. And even LinkedIn, I'm surprised it's only $80 million in advertising revenue. So there's a little data in here. I won't do the analysis, but you can look at it. So it's going to be critical to understand how much cash your business is going to need. Putting together cash flow is the most challenging exercise in accounting, because you're taking your income statement and feeding your balance sheet, and then from your balance sheet you're feeding your cash flow, and from your cash flow you're creating a plug number into your balance sheet that makes it all balance out. And that plug number is called cash. And so any mistake that you make in your model shows up in cash, because your balance sheet always has to balance. And so it's a very tortuous process and very error prone, even for someone who's pretty savvy with both spreadsheets and accounting. So I say take a simple approach. If you want to do it the hard way, that's great, but do it the simple way and see if those two line up roughly, and then you'll know that your more sophisticated model is accurate. So just look at the cumulative operating losses of the business up until the time when it turns profitable, and just add that up, and then add up all the stuff that you need to buy. When I say stuff, capital equipment, all the computers, maybe you need to buy vehicles, maybe you need to buy dunk tanks, whatever you're buying, all the hard stuff, all the capital goods that you need. Add those two numbers together, and that's a pretty good proxy for how much cash you're going to need for your business. Because once you turn profitable, then you should be throwing off cash, or at least not chewing up a lot of cash. Now, I understand the open table example, or maybe they were profitable, but they were still using a lot of cash. So you got to factor a little bit of that in, but this will give you a pretty good proxy for how much cash you're going to need. And then a question I get asked a lot is, how much should I pay myself? I'm a graduate at MIT, but I'm going to be CEO. When I hear CEOs make a lot of money, so maybe I should pay myself. I mean, it's only fair that I get a lot of money. So what I would say is, look at what you could get if you're a chemical engineering PhD, what does a chemical engineering PhD generally get? And give yourself something roughly in line with that, as long as it's enough to live on. So they don't want you to they don't want you to starve, but they don't want you to be so comfortable with the salary that you're not compelled to really make this business a big success. Okay, so don't go cheap on yourself. Pay yourself enough money to where you don't have to worry about paying your bills. If your car breaks, you can take it to the shop and get it fixed, because they want you working all the time. So anything that's going to distract you from working is bad. So they want to make sure you have enough money to get to the office, and that you have plenty of food to stay, plenty of Red Bull or whatever you like to drink. Okay. So let's get into this. So here's what we're trying to get to. We're trying to get to a 4-year profit and loss statement or income statement, right? And so I've got this color-coded. So we're moving from the presentation to the template. And I hear this is a big hit in Pakistan. So if it's color-coded, it's color-coded. If it's blue, it means it comes from another spreadsheet. So if we look at our highest level, all of the data here comes from another spreadsheet. So there's no data input into this spreadsheet. And in fact, if we look at our quarterly data, all of the data there comes from another spreadsheet. So your quarterly, I would urge you, at least in the initial stages, don't do a monthly financial plan, because you're going to be fat fingering a lot of numbers in. 16 quarters is enough to manage. 48 months is way too much to manage. Now, once you get your 16 quarters, 4 years looking good, then you can take your first 4 quarters and do a monthly based on that. But get the high level first, and then get into the really specifics in year 1. So in our quarterly, again, nothing is input into this spreadsheet. So here we have our sales forecast. And so this one I used unit sales, but you could also do, and rather than unit sales, you could say typical sale, right? So you could say our typical sale is going to be 10 probes and 1 piece of hardware, although it gets a little complicated because the cost of goods are a little bit different there. So I'd have to think about how I would model that and put that in here to be able to explain it. So here we have, if it's red, it means it's input. So all I did here in red is I input, we have 3 models, and we have various volume being sold. And here we have the revenue per model that we plug in once, and then this magenta is just a calculation of the cost of the sales price per model times the number of models, and there you go. And then the black is a calculation adding those up. And then our cost of goods is per unit as well, and then this number goes to another spreadsheet. I guess my total revenue should go to another spreadsheet as well. So we have then our staffing plan. So think of our staffing plan. Again, this goes out here to Q4 of year 4, and then this goes down here to encompass all of the departments. And what I would say is have enough descriptive information so you can tell what these people do, but there's no reason to put junior programmer, senior programmer, advanced programmer 3. Just kind of maybe have a senior programmer and a junior programmer, or maybe just have 1 programmer level. Try to glom the number of categories of people to where, it's a manageable number, but it's descriptive enough. And so if you have algorithm engineers, who are really programmers, but they're getting $130,000 a year instead of $90,000 a year, those are a separate category. Make sure you put those in separately. So 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 you have, your, all of your titles and the number of people within each category. So not separate individuals, but the number within that category. Okay, then you have your salary expenses, so you kind of take a copy of that other spreadsheet, but on this one you add in, you plug in a salary per person, and then you just multiply, 150 divided by 4 gives you your quarterly expense times the number of people that you have in that position gives you your expense, but lever it up with your cost of living expense, with your benefits at 15%. But of course, even in startup companies, people like to get raises. They're funny like that. So a year from now, they're going to want to make more money. They don't care that you're not making money. They don't care that you've given them a bunch of stock. They say, hey, Starbucks raised prices by a quarter. I need a little more money. So you've built that into your model. And so what I said, my kind of rule of thumb is an 8%, if you plan on an 8% increase, that's pretty good. You can get by with that in terms of budgeting. And so just do it on a quarterly basis, and starting in Q1 of year 2, just add 2% to your salaries and just increase it by 2%. And that also helps us with our problem, because typically in year 4, our expenses are not high enough, generally because we haven't brought in enough staff, but also because we're not reflecting what, 4 years from now, everyone's going to cost us 20% more than they cost today, because they're going to have gotten a number of raises. Expenses is pretty straightforward, although I would recommend using formulas wherever you can. So for example, in my engineering, I assume that my engineers consume about $2,000 of stuff, be it cables, be it software, be it oscilloscopes. Over the course of the department, I will end up spending about $2,000 per engineer per month on stuff. And so this way, if I build this into my formula, I put my $2,000 here, and then this just looks at my staffing plan and multiplies it out. And so it lets my staffing plan, again, be that key driver, and I don't have to come in here and start fat fingering things, which consumes so much time and is so error prone. So anywhere you can put in a formula, put in a formula. Sometimes the formula would be based on headcount. Sometimes it would be based on revenue as a percentage of revenue. Again, here's travel per person. Sometimes it's usually, again, based on per person is a great way to go. Yep. So we take all that data, that gets us back to our quarterly, that all feeds back to our quarterly, and then what you'll be doing as you put this together is you'll keep flipping back from your annual and looking at those numbers, and then going into the detail and fine-tuning it and changing it around, and then coming back to the annual, looking at it, and then once the annual starts to look right, go into your quarterlies and look at them and make sure that you don't have R&D expenses going like this and like this and like this, or any of your expenses. What you want to have is a nice steady line, unless there's a reason for it. So for example, you have no marketing in the beginning, you have very high marketing in year 1 because you're launching the product, and then your marketing comes down after you've launched the product. That's fine. Just be prepared to explain anytime your expenses are doing this instead of a nice steady line in one direction or the other. There's also the cash flow projections, which I've talked about. So there's an example in here. And some suggestions, about what to put in to your financial presentations. So any questions on putting together your spreadsheet? Okay, great. I've got, let me just spend 2 minutes in thinking about your equity. There's a couple of philosophical issues in the beginning here, but recognize that the amount of work that has yet to be completed almost always exceeds the work that has been completed to date, no matter where you are in the company, right? And it's the people who get the company across the finish line, or into the end zone that should get the lion's share of the rewards, okay? So it's the people who get it to a sale or are there when it gets to an IPO that really you need to make sure that those people are taken care of for seeing it all the way through. I used to not be a big believer in founders having to vest. I always thought it was a ploy by the VCs to screw the founders and make sure that someone loses their share so that they would have a higher percentage. In reality, I think that not having people vest opens you up to a big risk of one of the founders leaving, one or more of the founders leaving after a very short period of time, leaving the remaining founders to hold the bag, to really carry their water while they're off making, they can take a job, get a big salary, not have to sweat out the hours that you're doing at a low salary, and yet if they don't vest, they get to leave with their stock and they get the same share as everyone else. So I would urge everyone to vest. So let's just, the kind of rules of thumb are that the CEO, again, this would be non-founders. CEO would have about 5%. Your VPs would be in the 1 to 2.5% range. Senior managers at 0.25%, and individual contributors at 0.1%. And founding management you could see them having 2 to 3 times this. And if you're not going to take a lot of venture money, it could be way over the top. But I'm assuming that you're going to be kind of follow the classic profile where there's about 70 to 75% dilution. Okay. So as you think about it, just like in my business plan financials, I like to start at the end. So what I like to do is say, where are we going to get to out here, and look at all either the individuals or the categories of people and how much equity they're going to have. And then here I've figured it out on a per person basis. And then I work my way through this, and I keep looking at this and tweaking things in here as we go along to get there. I started at Reveal Imaging. I sat down with the CEO and basically this spreadsheet and said, here's what we can do for people going forward. And I put together the option plan and really the plan for all of the employees. So the first step is you have a founding team that has a certain number of shares. And how this gets distributed is really depends on the team, the dynamics of the team, what everyone brings to the team. And so this segment of the spreadsheet is different in every company, okay? Then it gets to be more predictable as you set aside shares for key employees or advisors and the option pool. You then bring in angel investors and the amount of equity that they're going to get. You then have a VC round 1 and a VC round 2, and you can see what happens to the shares as they get your ownership percentage. Your shares stay the same throughout this whole process, but your ownership percentages get diluted. And if you don't like what you see out here at the end, then you got to do something different in the steps along there. So with that, I made it with a minute to spare, and any last questions? One here.
Can you make the spreadsheet available, like the template?
Yeah, so both the PowerPoint and the template are available, will be available on the website. Yes?
Can you provide some more clarification in terms of what you mean by 5 to 10 times for the founding employees?
See me afterwards, and I can and we can talk about that. So thank you very much for having me.